Hello and good evening everyone. Today's webinar topic is Smart Tax Filing for Annual Year 2025-26, New Rules, Common Errors and Compliance Strategies. On this special occasion of Chartered Accountants Day, we are honored to have with us Mr. Arvind Rao, a distinguished chartered accountant and certified financial planner with over 20 years of experience in the field of financial advisory. Arvind Swartz's experience spans income tax advisory, business consultancy, and personal financial planning, making him one of the most sought-after professionals in the industry. He has a passion for holistic approach, problem solving, helping individuals and families to improve their financial habits for long-term success. In addition to his advisory work, Arvind is a well-respected author and thought leader, having co-authored the Expatriate Taxation Book for ICAI and contributed to major publications such as DNA Money, Business Standard, Outlook Money, and more. He is also a key member of Bloomberg Quint's expert panel on financial planning and tax matters. Now a glimpse about NISM. NISM is a public trust established in 2006 by the SEBI, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at various levels aimed at enhancing the quality standards in security markets. Before beginning this session, I would like to request all the participants to note some important points. First, question will be taken at the end during the Q&A segment. Second, all participants will receive a participation certificate within 3 to 4 working days. Third, the recording of this session will be available on the NISM's YouTube channel. Now I request Sir to begin with this session.
Thank you so much for the kind introduction and good evening all. 1st July, of course, is CA Day, but I think one of the reasons to select this topic for today is that tax filing season has also begun. And although this year there is some reprieve in terms of the date getting extended to 15 September, however, there is nothing stopping people to at least start preparing their tax filings. And last budget was quite an eventful one, which is the 2024, in which a lot of changes happened. And in fact, it is one of those reasons of those changes that few of the tax filing utilities have still not been made available by the department, which is what explains the pushing of the due date to a later date. So let's get into more of this. Okay. So what are we typically going to highlight today is one is looking at the major changes. Typically, we have heard about this and discussed maybe a lot when the budget came out in July 24. But when it comes to implementing the changes in this return filing season, it's best to recap a lot of those and be aware of the same. Some updates in the ITR forms, common filing mistakes that we have observed, and some practical filing guidelines, followed with few tax planning tips. And finally, like Sahil mentioned, that we'll also try and answer as many questions that you may have as possible. Talking about the key highlights, we are going to focus on three main changes that impacts assessees like you and me. Okay. First, what continued is that the new tax regime is now the default regime, which means for individuals and HUFs, if no choice is made in the return, it will be deemed that it's a new tax regime. Which means for all those of you who wish to take advantage of the deductions, or in those scenarios where claiming deductions is more beneficial for you, you have to opt out and go for the old regime. Otherwise, by default, it is the new regime. Now, one point I would like to highlight here, which we observed in the last year, because that was the first time when new regime was the default regime. It goes like this. A lot of you who may be salaried taxpayers would have claimed some deductions and made declarations to the employer under the old regime, right? Specifically, I'm talking about people who wish to claim the house rent allowance deduction that they claim coupled with the ATC, ATD, and so on. Now, the problem in having new tax regime as the default regime is that if you miss the due date, which is currently 15 September, and you are trying to file your return beyond this, you don't have an option to opt out of old regime, which means by default you will fall under new regime, and this can be quite a blow for those who claim deductions under old regime and have got their deductions under salaries as per that regime. The moment you go under new regime, those deductions don't become applicable and it may result in a higher liability for you. So if you have opted for old regime, please ensure that you file your returns within the due date. Second is the whole rationalization of the capital gains that were made, which is now there is a uniform 12.5% LD, and indexation has been abolished for all long-term capital gains. The fallout of that is the equity long-term capital gains, whether it is on equity shares or equity mutual funds, has also been enhanced from 1 lakh to 1.25 lakh per annum. So these are the three more important things. Let's focus on the capital gains, because I think that is where the major confusion or the major benefit or disadvantage also lies, right? The critical date to note here was 23rd July 2024, which is predominantly the date on which the budget was passed. So the transactions that might have happened in relation to capital gains before this date, the rates were like this: that long-term capital gains on equity were taxed at 10%, and on all other assets was 20% with indexation, and indexation benefit was also available. Okay, so what we are trying to imply here is, in case you have incurred any long-term capital gains prior to July 23, 24, you can still claim indexation for non-equity, and for equity the rate is 10%. After July 23rd, what has happened is rates have undergone a change, indexation has stopped, and the short-term gain rates are also higher. So now the long-term gain rates are a uniform 12.5% across all assets, whether it is equities, debt, gold, properties, all of them follow 12.5%. And of course, indexation is not available. STCG is now at 20% for equities, and for all other assets, it is at slab rates. The other important change that happened was that the time period for which you hold certain assets, which defines whether they are long-term or short-term, also underwent a change, or I would say got rationalized, right? So the way it stands now is that only for equity assets, the period of holding is 12 months or below for making it short term, and about 12 months makes it long term. For all other assets, it is now uniform at 24 months. So it's very simple. Earlier, there was an anomaly where there used to be 12, 24, and 36. Now 36 has been totally removed. So even when it comes to properties or even gold, 24 months and beyond makes it long. Now, for the sake of simplicity and a quick reference, this is the tabulation for various asset class and recapping the holding period, which makes them short term, and what are the short term rates. Okay, so it is self-explanatory, but I'll still take you through it. Like equity shares less than or equal to 12, short term at 20. Equity mutual funds, same period of holding, taxed at 20%. If you're holding and selling any units of real estate investment trusts, or even the investment InvITs, as they are called, investment trusts, infrastructure investment trusts, there as well, it is 12 months and less at 20. And for equity index or even non-index ETFs, if they are listed, period of holding is less than or equal to 12 and taxed at 20. Debt mutual funds. Now, this is the other space where an amendment was made in the last budget, wherein they have defined what are debt mutual funds. So earlier, when they made in on the 1st of April 23, when they brought the change that now debt funds are going to be there is no long-term capital gain. It will always be short-term. There was a little ambiguity in that definition, which has now got changed, wherein the act has defined that debt mutual funds are those which are investing at least 65% in the debt market. Those mutual funds will only be taxed at these always short-term rates. So holding of period doesn't matter. They will always be taxed as per short-term and at slab rates. Same is the treatment for unlisted bonds and debentures, that no matter for what period you hold, they will always be short term and taxed at slab rates. But when it comes to listed bonds and debentures, there is again an exception where it is 12 months. And although the short term is taxed at slab rates, but the period of holding matters. Uh, let's come to the other asset class, which is gold. So gold ETFs will again be listed, and hence less than 12 months makes it short term. However, if you have invested in gold funds, which is mutual funds that invest in gold, or if you're holding physical gold, whether it is gold coins, gold bars, less than or equal to 24 makes it short term, taxable at slab rates. This is as regards gold. And when it comes to properties, whether it's an home, office, shop, land, whatever, 24 months or less is short term, taxable at slab. And a few other assets where a lot of people have got stakes in now are people have started investing in international equities, right? Now, although these are equities and they are listed on a foreign stock exchange, they still are counted as international shares, and which are not listed on the domestic in exchanges. Hence, they for them the holding period is again 24 months and less, which makes it short term, taxable at slab. And if unlisted shares, as in whether they are Indian or international, whichever the case may be, less than or equal to 24 months is the short term holding period, taxed at slab rates. Same table if we were to look at how does long-term capital gains look. So holding period will be exactly around. So and as you will see here, all the equity ones, whether it is shares or mutual funds, get taxed at 12.5. REITs or InvITs, as well as index or non-index ETFs, will also get taxed at 12.5 in the long term. However, they are subject to an exemption of 1.25 lakhs per annum. Up to, for all the participants here, please note that 1.25 lakh is the exemption. Okay. So if somebody has long-term capital gains from equity shares, for example, at 2 lakhs. So what happens then? The answer is that for the first 1.25 lakh, there is zero tax, and you will have to pay 12.5% only on the balance, which is 75,000. Many people have this confusion that if I get long-term capital gains worth 2 lakhs, will I have to pay tax on the whole amount because it is in excess of 1.25? So the answer is no. 1.25 is the exemption limit up to which there is no tax, and only gains beyond that will be liable to tax. Debt mutual funds and unlisted bonds, debentures, like I mentioned, these are always short term. So there is no long term rates that apply here. When it comes to listed bonds, gold ETFs, gold funds, physical gold, property, international shares, unlisted shares. Now, friends, except for listed bonds and gold ETFs, because they are listed, 12 month is the holding period, which makes them beyond 12 months, make them long term. But for all other of these asset classes, now it is very clear and simple that holding period beyond 24 months makes them long term, and they will be liable to tax at 12.5%. So as you can see on the screen in this encapsulated table, that rates and the holding periods have got rationalized as well. Special mention to buyback transactions. Okay, so up to 30 September 24, the rules that were applicable for buyback transactions were, I would say, very different from the way they are now from the 1st of October 24. Earlier, uh, whatever money a shareholder got by way of tendering their shares for buyback, those were entirely exempt or tax free in the hands of the investor, because the company who was doing this buyback were liable to pay a certain tax on this buyback at their end. So it was like tax paid at source by the company engaging in this buyback transaction. However, from 1st October 24, that has been stopped. And now, whatever money the shareholder receives, that money will be taxed as dividend under the head income from other source. Yes, you heard it right. The entire consideration that you get as a result of buyback is liable to be taxed as dividend under other sources. And the moment you talk about dividend and other sources, it will be liable to tax as per your slab rates. So for any shareholders who are not in the higher tax slabs, they will end up paying lower taxes on the buyback money that they get, which is very different from the way it was taxed earlier. Because earlier, since the entire the company used to pay the tax at source, it was the same tax rate for each shareholder. Now things have changed. It is based on each shareholder's applicable slab rate. Now, you may be wondering what happens to the amount that the shareholder has paid to buy these shares, right? Because if the law says that now the entire consideration that you get is liable to be taxed as dividend, the amendment that has got has said that whatever money you have paid to buy these shares, or what is called as cost of buying these shares, now has to be claimed as a loss under the head capital gains. So whether will it be a short-term loss or a long-term loss will depend upon the period for which those shares were held by the shareholder. So as we have already discussed, less than or equal to 12 months will make it a short-term loss. And if it is beyond 12 months, it will make it a long-term loss. So these losses, of course, you'll need some other gains under the head capital gains made available so that you can set it off. But now the law is clear that they will segregate the cost and the sale consideration as capital losses and dividends. So this is very, very, very important because there is a big change in the way the buyback transactions were treated. Let's come to the next segment, which is changes that have occurred in the ITR forms. So we'll look at the non-business forms, because business forms, we are not trying to get the business taxation into picture today here. First is the ITR 1. So I think the major change that has come in ITR 1 now is that earlier ITR 1 was not available for people having capital gains. Now, for all those people who are having long-term capital gains, which is below the exemption limit, that is 1.25 lakh per annum, can also file their returns in ITR 1 with showing whatever is the exempt long-term capital gains. So why I'm saying this is a big relief is because between ITR 1 and ITR 2, ITR 1 is the relatively smaller and the simpler form that is available for shareholders. So by enabling long-term capital gains, especially the exempt ones that can be filled in the ITR 1, it kind of brings a big relief for a lot of taxpayers who don't have taxable capital gains. So basically the small investors, they don't need to go to a longer ITR 2 form because they can easily get covered here. ITR 2, which is where the major changes are, because now the form requires a pre and post 23rd July reporting. And as we have already seen, there has been quite a few changes in terms of the rates as well as in terms of the period of holding for various asset classes, right? So ITR 2 is where all the action has to unfold. And this is the reason why the department has not yet released the tax filing utility for the ITR 2 form. It has not yet been made available for filing. And we have to wait and watch when it is available, so that accordingly the returns for that period can be filed. And of course, ITR 2 will also now have a separate section for reporting the buyback proceeds, especially those buybacks that have happened after 1st of October 24. ITR 4 is basically although it's applicable for business or professional cases, but this is falling under those presumptive segments, like the 44AD for business and 44ADA for professionals, where you offer a fixed percentage of your turnover as profits. In case of business, it is minimum 6%. And in case of professional income, it is minimum 50%. So people who opt to file their business or small businesses or small professional income under this section, there has been some additional reportings that have been introduced in relation to the presumptive income. So ITR 4 has some minor changes in relation to that. Now, within the form, what has been already declared or disclosed by the department are the new requirements is something like this. How they will actually look in the utility, we don't know yet, but these are the mandatory reportings that are now applicable, which is two categories of transactions, which is all transactions that have happened before 23rd and after. And they have added some new fields as well, which is indexation versus non-indexation. So for all the participants here, I would like to add one more thing, that when the budget announced the changes and abolition of indexation for all long-term capital assets, including property, there was a lot of opposition and hue and cry against it. So for resident taxpayers, there is a benefit that has been provided by the law, which states that if you are a resident and you have sold some property, especially residential property, after 23rd of July 2024, when you are calculating long-term capital gains on that, you have a choice. You may calculate your long-term capital gains using indexation, and you can also calculate your long-term capital gains with non-indexation. Apply 20% taxation on the indexed gains and a 12.5% tax on the non-indexed gains. Compare the two, and whichever is favorable, the resident taxpayer has a choice to opt for that. Friends, this is the exception that has been provided only for resident taxpayers, and that too for capital gains on properties, on residential properties. So if there is a non-resident who has sold a property after 23rd of July or is going to sell it anytime from here, they don't have this choice. So they have to compulsorily pay 12.5% on non-indexed gains on these property transactions. So that was more about the indexation versus non-indexation. There are enhanced validation checks that have now been introduced within the utility. Basically, validations happens with the information that is available in the AIS and the 26AS. And there are separate sections that have been provided for computation of tax, because since the tax rates are also different, before 23rd and after 23rd, there will be separate computation applicable, separate tables that will show the computation of tax on these gains. Filing dates predominantly for non-audit cases, the filing dates are 31st of July. But this year, early June, the department has already extended the dates for non-audit cases to September 15th. For audit cases, the due date is 31st of October. It is not yet known whether, because there has been an extension for non-audit cases to 15 September, does it mean that audit cases also get extended? That information has not yet been made public. So as we speak, the audit due date stands at 31st October. We have to wait for any notification that comes from the department. Now, although the due date has got extended to September 15th, please note that in case there are some of us who still uh, manage to not file it within time, the late filing penalty of 234F is still applicable, and which implies that it is very important to plan and file the returns on time, so that, one, like I mentioned some time back, uh, if you want to claim the benefits under the old regime for a salaried guy, and if you have already claimed the benefits under old regime in your in your company declarations, and your taxes have been deducted as per those rates, and you want to opt in for the old regime, it is mandatory for you to file your return before September. Or I think the other way out is, if someone still feels that they might miss the deadline, they can always try and opt in. There is a form that's called, I think, form 10F, which you have to like upload with at the portal, showing your opting in for the old regime. So at least do that within the due date. Let's come to some common mistakes that are commonly seen. So one is capital gain reporting errors. So for this year, it's very important that we don't mix the pre and post July 23, because why this becomes very pertinent now is because this is the first time that there is a breakup of capital gains within the same year. So I have seen normally lot of taxpayers doing this, which is nowadays people who are active in stock markets or who actively buy and sell in mutual funds. Uh, those detailed capital gain reports are very easily available, as in your stockbrokers provide them, or if you were to get the detailed reports from your mutual fund distributor, they also provide you those reports. And even CAMS or Carvi or any of these registrar agents also provide you with the detailed capital gain report. So getting that information is not a challenge, but what lots of people resort to is that ideally what is required is transaction level entries need to be made in the income tax forms. This year, because of this divide between pre 23 July and post 23 July, it is important to note this. So I have seen a lot of people, what they do is they just pick out the total capital gain figure from these reports, whether it is from the stockbroker or from the mutual fund portfolio. People pick up the total and input that figure into the capital gain module, wherein they show that this is my sale consideration, this is my purchase cost, and this is my long-term capital gains. Now that won't work, because even if you have to do this consolidated reporting, if I can use the term, that can be done at the July 23rd level. So you'll need to consolidate all transactions up to July 23, report those separately, and post July 23, report them separately, and ensure that you are applying the correct tax rates to these transactions. So don't apply the old tax rates to the new transactions, which will work to your benefit. But the bigger worry is, don't apply the new tax rates to the old transactions, because that will also work against you. uh, don't claim indexation benefit post July 23, and be very careful when you are looking at especially mutual funds. When you have debt and equity mutual funds, segregate and ensure that you are showing debt funds as debt funds and equity funds as equity funds. Specific care to be taken for hybrid funds, like for example, within hybrid funds you have equity based hybrid funds and debt based hybrid funds, for which the long term capital gain tax rate will vary. Okay, so care to be taken there. And one more care to be taken is when it comes to debt funds. Now, like we saw, debt funds in the last, I think, 2 years have undergone a lot of changes. So basically, uh, all those debt funds that have been bought prior to 1st April 23, they still qualify for long term and short term, because the amendment for making debt funds only short term is applicable for funds invested post 1st April 23. But if you have sold debt funds which you have bought prior to 1st April 23 and you are selling them before 23rd of July 24, you can still claim indexation on it. But these debt funds, if I can call them as the older debt funds, if you are selling after 23rd July, you cannot claim indexation. So please pay very, very important attention to your debt funds and how the capital gains on the same need to be accounted for. Some simple do's: maintain separate transaction records and ensure that you're using the 12.5% tax rate for LTCG post July 23. And whenever, if you want to use consolidated reporting, ensure that you're using the cutoff dates clearly, like for the debt funds as well as for the equity funds. Second mistake that people see is the people do is the tax regime. So normally what happens is, when you are filing your returns, there is some inertia when it comes to non numerical information. So like, when it is about inputting data in relation to your income, whether salary, other sources, people tend to change that. But non numerical information, which is like your email ID, your mobile number, your address, your tax regime, if these are not checked, and if you go on an autopilot mode saying that whatever I did last time I will continue, don't do that. Because there maybe in your declaration you have figured out that there is a change required, because salaried taxpayers are those privileged taxpayers who are allowed to shift between the old and the new tax regime every year, okay, depending upon the situation. So in case you have taken a call like that, don't follow the autopilot and ensure that you are selecting the correct regime. And I have also seen cases where people claim deductions under the new regime also. There are some specific deductions. For example, the NPS. That is one of the deduction that is still available in the new regime. So, by mistake, people claim this, although they might not have claimed these deductions. So don't do these mistakes. And for those under old regime, the forms have now got specific reportings for various of these deductions, like HRA, or even the deductions of that disabled, having disabled dependents. If you want to claim some deductions, there are some forms that need to be uploaded. All those details are now being asked at the form level itself. So ensure that you are doing it correct. The best do here is, ideally, I mean, I personally believe that don't go by thumb rules. Best way is, take whenever you're doing your calculation, calculate tax for that same income under both regimes and see for yourself whichever is lower, opt for that. Normally people want to use shortcuts or thumb rule, saying that if the income is up to this, I think old regime is better. So why do that when it is a matter of filing the tax? And when you have the benefit of claiming whichever is favorable or beneficial, you can always do that one little extra exercise in the end, which is, do the manual calculation or an auto populated calculation, see the tax figure and then decide, right? The third mistake which we can highlight is oversights when it comes to income reporting. So, my dear friends, this is getting very, very important because last season, for the returns that were filed, no, we have seen some new kinds of reportings that the department came up in the month of March 25, before the financial year ended. No? So I'll give you one example. So some of you may be aware that if you are paying rent to, I mean, if you're staying in a rented accommodation and you're paying rent, and if the rent that you're paying is in excess of 50,000 rupees per month, as a non-business person, I mean, as a normal salaried person, if you're paying rent which is in excess of 50,000, you are required to deduct tax at source, what is called as TDS, at the rate of 5% on that amount before you pay that rent to your landlord. Of course, this is an annual exercise, so you're required to do this only in the month of March. So believe it or not, but in the month of March 25, the department sent out, notice may not be the right word, intimations to people where they saw that they were claiming HRA deductions in the excess of 6 or 7 lakhs per annum. The moment your HRA deduction is more than 6 lakh per annum, that means automatically your rental payments are more than 50,000 per month. But if they have not found that, if they have found that these people have not deducted tax, the TDS on their rentals, they were sent intimations asking why they have not deducted the TDS. So the lesson to be learned here is that whatever income is getting reported, you need to be really clear whether all the applicable deductions, mismatches, cross reportings, all those have been taken care of. Some of the frequently missed incomes are like crypto transactions are not reported. But please note that there is a flat 30% rate on these virtual digital assets that you have to pay. So don't ignore them. And as per the rules applicable, any losses that you incur on crypto transactions, you cannot offset it against even gains made from crypto transactions itself. So all crypto incomes are liable to tax as per their profits, and any losses made, you cannot offset it. Foreign income disclosure. So whether it is your foreign account, your income, dividends on your ESOPs or RSUs that you may be holding, or if there are some demat accounts that you have abroad, all those are liable to be reported for resident taxpayers. So ensure that you're doing it, because there are good penalties for not reporting these transactions. TDS mismatches with 26AS. Despite Form 26AS being there for now close to 7-8 years, still a lot of taxpayers ignore the TDS and the income that is seen in the 26AS, and it is not reflected in the ITR. Ensure that these are done. And also, the fourth step is to ensure that all the income that is seen in the AIS is reported in your income tax return. Friends, there is also a facility available. I mean, I'm not saying that all the information reported in AIS may be accurate. There could be certain errors, but there is a separate AIS compliance portal where you can go and report that this income does not belong to you or is not to be counted as part of your income. It is important to do that, because if you don't do it and if you file your return ignoring that, that becomes the reason for the mismatch intimations to be given to you. And people generally don't maintain adequate documentation for their income and some deductions that they wish to claim, which can prove to be an issue, especially if there is a scrutiny that happens. So in fact, June month, a lot of people got scrutiny notices. And in fact, there were news articles also that there was mass scrutiny notices that people have got. So in such cases, ensuring that you have documentations kept proper will only help your case. Um, so a very quick pre-filing checklist. Ensure that 26AS is checked, capital gains, the divisions are done, tax regime comparison is done, investment proofs, whatever you have claimed, you have organized and stored it in a proper way. And finally, bank account details that you input in your tax returns are duly verified, pre-validated or verified, because without that, refunds are not getting credited to the account if your bank accounts are not verified and validated, and have supporting documents kept ready. Post filing certain actions, like immediately have the ITR-V, the receipt, to be downloaded and kept available, and ensure that you're doing the e-verification, which is either you do it via your Aadhaar. I mean, there are multiple ways you can do, but typically people um, end up forgetting to e-verify their returns, although the department does send certain reminders. But friends, please note that if you forget to e-verify and the due date passes and the due date is passed, then it will be treated as if you have not filed your return, because e-verification is a very, very, very important part of the filing process to complete it, right? And after you have done all this, you can track your refund status from the IT portal itself, and ensure that whatever records we said you have to maintain it for at least 6 years, because on an assessment level, the department is allowed to go back up to the last 6 years. And last but not the least, plan for next year. Okay. Certain tips to for this webinar from a tax management perspective is that whenever as an investor you take certain decisions, always factor in the tax impact. Okay. For example, we have seen instances where especially employees who get international ESOPs, they are so excited when they see that the share price is up and they want to sell it. But keeping in mind that there is a huge difference in tax rates when it comes to the short term or the long term. Like for example, international shares, if you sell it before 24 months, you have to pay the tax on the gains at slab rates. So if you are in the 30% with surcharge slab rate, which could go as high as 35 or even 39%, so sometimes taxpayers miss I mean, in the euphoria that the share prices have gone up, I've seen them selling shares in the 23rd month, right? So waiting for one more month would ensure that instead of 35, 39, or 30%, you will pay at a 12.5% long-term gain tax rate, right? That is very, very important. So any decision in relation to your portfolio that you take, especially the sale decisions, ensure that you're looking at the tax impact. It may also be a wise idea that if you're looking to reinvest, whatever is the tax, you keep that money aside from the money that you get, and you pay it upfront, so that you don't invest that and at the end of the year when you're filing your returns, you're like, okay, where do I get the money for this? So very, very important. Plan around the July 23 cutoff. So again, same thing, whether it is 12.5, 20, those things can be checked. Always have an annual review which tax regime is beneficial for you. Like for example, for this financial year, that is 25-26, not the assessment year, friends. The webinar is for assessment year 25-26, but for financial year 25-26, there has been a huge rejig in the new regime tax slabs. Okay. So, I mean, just a back of the envelope numbers say that old regime now makes sense only for those taxpayers who wish to claim 8.5 lakh or beyond deductions, right? So that's a huge number. So just because last year old regime worked for you, don't assume or go in an autopilot mode. This year also review what makes more sense for your income. Prepare for advance tax. Now, typically I have seen non-business taxpayers, especially salaried taxpayers, feeling that advance tax is not for me because my employer is deducting TDS on my salary, and for any other income that I have, especially interest income, bank is deducting TDS. So friends, this is a big myth, because advance tax has got nothing to do with the type of your income. The law says that as long as you are paying more than 10,000 rupees towards self-assessment tax, you are liable to pay advance tax in the previous year. So keep always have an extrapolation of your income. Although bank is deducting 10% TDS on your interest income, note that it is only 10%. If you are in the higher tax bracket, you will have to deduct more, you will have to pay the differential tax, right? So keeping that in mind, ensure that you follow those quarterly advance tax installments that are applicable, and keep an eye on the documentation maintenance. Most important, I think, for all those who have not done it yet, maybe after today's webinar, what you can do is draw out your tax compliance calendar. Which month, which date, what is the activity that you're supposed to do? If you have that, you can pin it up on your wall and just keep looking at it at the start of a month, so you know that you're not missing out on something. Before I take up the questions, just again encapsulating the key critical points that you need to bear in mind while you are doing your filings starting this month up to September. Let me check if there are questions. Okay. So there is a question which says, what if I have invested in ETFs which hold bonds, then what will be the rate applicable? So doesn't matter what the underlying is. If these ETFs are listed on the exchange, the rate is at the same as applicable for ETFs. Mon 100 ETF. So the simple answer to all ETF related questions are that if it is equity ETFs, short term is less than 12 months, taxable at slab, taxable at 20, and long term is after 12 months. For equity 12.5, even for non-equity it will be 12.5 now. Short term, before 12 months, equity ones will be at 20, non-equity ones will be at slab rates. Okay, next question is, what about when the rent is greater than 50,000 for an individual but is divided between two family members of the landlord? Great question. So the 50,000 threshold is per recipient. So if the landlord has divided the rent into two people, you have to see whether for each person you are paying more than 50,000 or not. If cumulatively the rent is say 60,000 but is getting divided as either a 40/20 or a 30/30, then you don't have to bother about the TDS. Yeah, so for these cases of paying TDS on rent, there is no requirement of TAN. If you visit your portal, there is a separate form called as Form 26QC, which facilitates payment of TDS on rent without a TAN. Only your PAN is sufficient. Kindly repeat the debt mutual funds purchased before July 24 and sold after 24. Yeah, so the dates is not July 24. I'm talking about debt mutual fund purchased prior to 31st of March 23 and sold after 23rd July 24. So here, because these debt funds have been purchased prior to 1st of April 23, they are still, you can still have long term and short term. So if you have held these debt funds for more than 24 months, those gains will still qualify as long term, liable to tax at 12.5%. And if you have held it for less than 24 months, you'll have to pay tax as per slab rates. What is the scope of carry forward of losses in futures and options trading? Okay, futures and options, firstly, they get taxed under the head business, and you can carry forward those losses for up to 8 years. So if this year you are not been able to set off, for the next 8 years, you can keep carrying it forward and offsetting it against any income under the head business, whether it is futures or options, or even if it is any other business income that you have, you can offset it against that too. 26 AS, AIS, TIS. Okay. So all the three have their own little roles that they perform, which is 26 AS was the first one that was introduced, which shows you all those incomes on which there has been certain TDS deducted and reported by the deductor. AIS evolved after that. So AIS not only reports those incomes which are shown in the 26 AS, but it also reports income on which taxes are not deducted. The TDS is not deducted. So for example, bank savings interest or dividends, which the companies have paid, but on which they have not deducted TDS, even those incomes get reported in AIS. Finally, TIS or the tax information summary is like a summary. So it shows you total interest income, total interest on securities, total dividends, total salary. So you need to compare this with your computation to check whether whatever totals are seen, have they been followed in your computation. Indexation, I can explain, but point is that it is no longer relevant, Ayush. The point was that um, the law held that when there is any gain that happens on a capital asset, the entire gain is not due to the appreciation of the asset. It is also due to the inflation in the economy. So the concept of indexation was to remove the inflation part from the appreciation and only tax the actual appreciation in the asset value. Uh, Actually, because of that, the tax rate was 20%. But last year, when they abolished indexation, they have also brought down the rate to 12.5. So logic is no indexation, you are also paying a lower rate. Thank you for all those who are wishing me a happy CA day. Thank you very much. NASDAQ 100 ETF also needs to be held for more than 24. That is correct. If income from other source and capital gains only, can we select old regime if last year in new regime? Yes, you can. You can. It's only for business cases that the switch is not allowed year on year. If someone has no other income but has capital gain, does he has no other income but does he still? Yes, yes. 1.25 lakh is strictly for capital gains. It has got no bearing with the other income. If I have got a dividend of rupees 10 only, which ITR should I file? So I'm a little confused. Is your income only 10 rupees or is the dividend only 10? I mean, if it's only 10 rupees dividend and I'm assuming you have some other income, then you can file under ITR 1. I have received salary from X, also have income from business as a partner and director in LLP. Which can I file? Which form best suited? Ideally, I think for what you're saying, ITR 3 is where your form that is the form which will be applicable for you. Unfortunately, the form is not yet available, so you'll have to still wait for your to be able to file your returns. But I think ITR 3 reports partnership, uh, directorship, as well as your salary. Um, okay. I am now actually there are some questions on the chat Q&A window also. I'll try and see how many I can cover. We have around 5 minutes. How to claim depreciation for EV car? Uh, uh, I mean, for that, most important, you need to have a business income because depreciation can only be claimed against business income. So if you are having a business and you have taken the EV car as an asset in your books, automatically you will be eligible to claim the depreciation. How are short-term losses and long-term capital gains offset when arising? Okay, good question. So, short-term losses can be offset against short-term gains as well as long-term gains. And whatever is the net, you have to pay taxes on that. But long-term losses can only be offset against long-term gains. Okay. So this is important. Again, short-term losses, long-term losses, if you have not been able to offset it during the year, you can always carry it forward for almost for the next 8 years. So till the next 8 years, you have an option to keep using these. NRIs slab rates will be the same rates as applicable to individuals. Yeah, so indexation benefit, actually indexation benefit was withdrawn for all assets, but for all the representations that happened post the budget, the how do I put it? The extension of allowing indexation only for properties was something that the government was okay to accept. For all other assets, they have not gone back to. CAs or individual taxpayers depend on capital gain reports from CAMS. Will CAMS provide pre-July 23 and post-July? So good question. I haven't gone and checked that yet. But here's the thing, generally CAMs or other registrars provide date-wise capital gain I mean, they provide transaction level information. So the moment they have given the dates, you can always segregate it at your level if they have not done it. Is it enough to file a schedule FA or FSI and TR is mandatory? It depends what all you have. So like if there is any income also coming from the foreign assets, then FSI is relevant. TR becomes relevant if you are also claiming any DTAA relief on that income. Otherwise, if there is no income, only assets, then FA should be sufficient. Why are income tax deductions not given for investment in mutual funds? Only the equity linked saving schemes were permitted. No, I mean, in the new regime, even that is not allowed. Yeah, okay. Is it recommended to pay advance taxes in single transaction or do it quarterly only? So the law says you have to pay advance tax as per those quarterly dates. Okay. It doesn't stop you from paying more tax on a date. So for example, I have sold, I mean, I'll go back to my ESOPs example. If I have sold ESOPs in the month of say November, and I am planning to reinvest that money in some other asset, right? So, like I said, we normally would advise that keep the tax money aside and do whatever is left from the balance. Now, you have a choice to either pay part of that advance tax in December and the rest in March. But if you want to just get rid of that and don't want to keep it as a pending action item in your list, even if you pay that full capital gains in December or November for that matter, the department will only be happier. Okay, there is nothing stopping you from doing that. My long term, which form to, if long term capital gain is more than 1.25 lakhs, then you'll have to file it under ITR 2. What is the implication for NRI of disclosures of remittances as foreign income? Good question, and it's a practical. It's a question that has practical implications. So ideally, there is no place in the ITR form wherein you can disclose this, because ideally foreign income is foreign income that is not liable to tax here. Okay. Just because you're remitting the money here doesn't make it an income liable to tax in India. Okay. So there is no way or no space that has been provided separately to report these remittances. But yes, I appreciate your question, Ashish, because whenever an NRI scrutiny, when NRI's case is picked up for scrutiny, typically the department keeps asking that, what is the source of these remittances? Can you show us that? So good question, but answer is, I mean, we don't see the space. So again, maintain adequate documentation, and if as and when that question comes, you have these things handy. Indexation available on debt mutual fund sold before 23rd July 24. Yes, provided those debt mutual funds have been bought prior to 1st April 23 only. That is very important to remember. Salaried person purchasing EV, sorry, but can't claim depreciation. It is not mandatory to file a nil return. The obligation to file a return is if your income is beyond the threshold of the taxable income, which is 2.5 lakh in case of old regime and 4 lakhs in case of new regime. Last question I'll just take up because this is linked, that there is no specific advantage if one were to pay advance tax. There is, because if you don't pay advance tax as per those installments, then there is an interest that you are liable to pay for either advance tax paid short, or if you have not paid at all. Now the way it works, it is 1% per month, um, starting from like generally for there are two types of interest. One which is liable between April to March of the year in which you are earning that income and you are liable to pay advance tax. And then there is again 1% per month which starts from April going right up to the date on which you pay the taxes and file your returns. So if you have paid excess advance tax than what you were required to, yes, then there is no advantage. But if you don't pay advance tax at all, then yes, there is a disadvantage, because that 1% depending upon 1% interest, depending upon the advance tax, can be quite a number. So better to always pay advance tax. Okay, so I hope I've been able to answer most of your questions. And I mean, I thank you for I mean, some of these questions were very, very relevant and important too, because not everything can get covered in the slide. So thank you so much. And like it was told in the beginning, I think the YouTube link will be available later as well. And anything, you can always get in touch with NISM, right? So just a parting quote, we commit to accurate, timely, and um, strategic tax compliance. So thank you so much for all your wishes for CA Day, and um, all the best from me too. Thank you.
Thank you so much, sir. I would like to extend our heartfelt thanks for taking the time to speak at our webinar. Thank you so much once again. Your insights, expertise, and engaging presentation made a lasting impact on our audience. And thank you once again for sharing your time and knowledge with us. Wishing you a wonderful day, sir. Thank you. Thank you so much for your time, sir. Thank
Thank
you.
you so much.